Welcome to the TreppWire Podcast, the show where commercial real estate meets data and insights. This is our week in review for the week ending July 17th, 2026. I'm Haley Keene with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Lonnie Hendry, Chief Product Officer, and Stephen Bushbaum, Head of Applied Research and Analytics. This week gave markets a surprisingly favorable inflation combination. Consumer prices fell in June, core inflation was flat, and today's producer price report also came in softer than expected. The catch is that lower energy prices did much of the work, and oil has already begun moving higher again. Meanwhile, the major banks delivered another strong quarter, powered by trading, underwriting, and deal-making, while loan balances, deposits, and consumer spending continue to grow. And in tech, IBM's preliminary results showed companies shifting spending toward AI servers and infrastructure, just as New York and a growing list of cities are pausing data center development over concerns about power costs, infrastructure, and community impacts. Finally, in this week's Digging Through the Data, we'll head to Austin, where widespread rent concessions are helping multifamily owners preserve occupancy, but not necessarily cash flow. We'll examine why delinquency remains relatively modest, even as Austin has the highest multifamily watchlist rate among the 50 largest U.S. MSAs, including a vintage-level breakdown of how occupancy and DSCR have deteriorated among watchlisted loans. Stephen, does this look like the soft landing combination that markets have been waiting for, or is the AI boom introducing an entirely new set of inflation, infrastructure, and labor market trade-offs?
I'm going to come out and say it straight out. Head fake. I think this report was great. I wanted to see it. I love to see it, but head fake. I mean, keep in mind, there's a strong base effect here. So with oil, or I should say gas prices declining as much as they did, and as great as that has been for all of us commuting or filling up cars, especially if you have a truck like Lonnie's. I'm sure, Lonnie, you've been really loving that decline in gas price. I don't feel great about how long this will last with all of a sudden this re-escalation in tensions and the strait getting closed again. So before we get into the numbers, I just got to ask Lonnie, did that decline in gas price put a little bit of smile on your face when you fill up the pump?
It's kind of like a rhetorical smile, if there's such a thing, where it's like, really? I mean, like, yeah, I'm excited it's less, but it doesn't mean it's cheap. Definitely a reprieve. I appreciate it. I'm not complaining. But even at that level, it's still about $155 to fill up.
So I think that's a pretty straightforward transition into our CPI numbers. Our headline CPI for June fell 0.4%. compared with forecasts of only a 0.1% decline. And then the year-over-year rate dropped from 4.2 to 3.5%. So back to your point, Lonnie, yeah, that's great. It declined month over month, but the absolute level of where we're still at isn't very pleasant to continue to feel at the pump. Now, core CPI was unchanged on the month and slowed to 2.6 annually versus expectations of a 0.2 monthly increase and a 2.8% annual increase. Now, interestingly, shelter increased just 0.1%, its smallest monthly gain since early 2021, which is particularly encouraging for the underlying inflation trend. Now, CPI wasn't the only inflation report we got this week. We also got Wednesday's PPI report that reinforced the inflation message. Producer prices fell 0.3%, surprising economists who expected no change in the month, while May's increase was revised down from 1.1 to 0.6%. Goods prices declined 1.4%, energy dropped 6.4%, gasoline fell 12%. The more stable measures that exclude food and energy and trade services rose just 0.1% for the month, but it was still up 5.1% a year earlier. So the pipeline inflation story has improved without disappearing. Now, one interesting wrinkle is that prices for computers and computing equipment increased 2.5%, showing that the AI infrastructure boom is creating its own pockets of cost pressure. Now, I suspect anyone that's been following the Micron memory chip shortage story and the recent Apple announcements of price hikes is probably going to be unsurprised by this 2.5% increase in computing equipment. Now, going along with this theme of elevated computing costs is just the overall backdrop of inflation that's become, well, embedded or sticky or stubborn as a result of the AI build out. So this is why you heard Kevin Warsh state this week that, well, this is great and everything. Inflation is still a problem. So the expectations for a July rate hike have been dialed back dramatically. I think I saw earlier this week is like a 50-50 chance. I'm a little bit more on the fading that trade of no expectation of a rate hike, but I do see in the tea leaves potential for a September hike if inflation continues to be stubborn, because as was pointed out on some economic commentary this week, interestingly, if the Fed were to hike rates in September, that might actually bolster the appearance of independence ahead of the November elections. So getting back to the inflation story, the obvious caveat is that energy delivered is a large portion of the relief. Gasoline fell 9.7% in the CPI and 12% PPI, but those numbers captured the temporary easing in oil markets. Middle East tensions have pushed gas prices higher again. So these reports are describing an inflationary event that's in the rearview mirror. So yes, again, this reduces the pressure on the Fed now, but there's no victory lap here. So we still have a lot to keep our finger on. I should say we have a lot to keep our eye on over the coming month, because this re-escalation in tensions potentially is just upping that chance of a Fed rate hike in September if these tensions continue to stay embedded and oil takes another leg back up. So Lonnie, I only covered a little bit here. We still had bank earnings. I mean, this is a rich week for us. And that's not even getting to some of the data we're going to talk to, the Trepp commercial real estate data that is going to be really, really fun. So can you tell us what we saw in bank earnings?
Well, before I jump to that, Stephen, just a couple of thoughts on your commentary. Obviously, you missed the memo. Inflation's over, man. This report, this read, just it's over. It's transitory. It was transitory all along. It just took 3 years to work its way through the system. This is done.
There it is. You pulled out the big T, Mr. T.
I think your commentary spot on it. It feels like a head fake. I mean, the re-escalation has some real potential just to ramp this right back up. But, all jokes aside, it's something to definitely keep our eye on. I mean, bank earnings, is a nice transition there. If you look at them, it looks like an economy that's expanding, not one that's sliding towards a recession. The recession word has been a little more prominent over the last couple of quarters. But if you look at JP Morgan's reported $21.2 billion of net income, that definitely had some large gains tied to the Visa shares and other investments. If you exclude those items, earnings were still $16.9 billion. Pretty remarkable. Average loans grew 10%, deposits increased 7%, debit and credit card spending rose 10%. The part that's really jumps off the page here, Stephen, investment banking fees jumped 30%. Markets revenue climbed 35%, including 86% increase in equities. I'll ask you in a second if we think this is sustainable, real. Is this an anomaly, or is this just where we're at? And it's supported. Goldman Sachs, very comparable, generated $20.3 billion in revenue, up $6.6 billion of net. And $6.6 billion of net earnings. So nice production from them. Investment banking fees were up 55%. Equities revenue up 72%. Morgan Stanley had record revenue of $21.3 billion, $5.6 billion of net income. Investment banking revenue for Morgan Stanley rose 56%. Equities increased 69%. And the firm gathered a remarkable $148 billion of new net wealth management assets. I mean, I think that's pretty remarkable. And the strength is broader than just the trading desks. If you look at BofA, they earned $9.1 billion on $31.6 billion of revenue. Citi posted its best quarterly revenue in a decade at $24.8 billion, and Wells Fargo earned $6.4 billion, with average loans up 12%, deposits up 10%, and credit quality remaining broadly stable. So if you put all this together, I think the bank showed active capital markets, growing balance sheets, consumers who are still spending, which we've talked about ad nauseum on our show. Even though Jamie Dimon warned that sticky inflation, geopolitical risk, fiscal deficits, and elevated asset prices continue to move beneath the surface, I think those were in a whisper relative to the proclamation that the earnings produced.
It's absolutely incredible. I mean, the equities trading at JP Morgan, that's nuts. That's absolutely nuts to me. So it'll be interesting to hear how bonus payouts look at some of these banks, because it has been, you've heard comments made about just how good it is. And in fact, the Wall Street Journal had a fantastic piece out this week. Jamie Dimon basically said exactly that. We look at this record-setting bank earnings run. Jamie Dimon came out and said the environment is, quote, as close to as good as it gets. That's it. this is about as good as it gets. How long can we sustain this? Maybe 1-2 more quarters? I don't know. I'll be interested to see how this plays out. But the thing that I am very encouraged by is that in these earnings releases, credit losses have stayed low and nearly every major business line benefited from favorable conditions. So in other words, credit has been performing just fine. And this isn't an isolated flash in the pan. It's a fairly well-diversified, all boats rise type situation. Now, the main weak spot was net interest margin, which remains relatively thin as banks compete harder for deposits. JP Morgan's margin slipped to 2.4%, Wells Fargo's to 2.43%, while Bank of America and Citigroup posted only modest improvement. Higher yielding alternatives continue to pressure banks' funding costs. I mean, shoot, the 80s taught us this lesson in spades. Customers move money in search of better returns. And in today's environment, that's super easy to do with electronic platforms. So banks are having to compete incredibly aggressively and really ruthlessly to try and retain business. The plus side is that these same banks are also excellent lenders. And to get the best loan terms, well, you typically need to keep your deposits with that bank. So you do get a little bit of stickiness on the lending side. Now, Lonnie, I don't know how you feel about this, but one thing that I'm interested to see play out as this banking cycle kind of plays out toward the end is book valuations, right? And maybe we won't see this necessarily on the banking side, but yeah, we can't keep our heads in the sand about where credit stands today, because if things do turn, there's a lot of balance sheets that are not marking to market, and we maybe have an inflated sense of protection and durability in the market.
So, Stephen, do you remember like when you were like a kid, maybe elementary school, first part of junior high, or whatever, and you start learning about matter, and when something's created, like it exists, it just maybe exists in a different form or shape or whatever. I mean, look, the risk in the system, it didn't evaporate. It just got shifted. Private credit took the risk. Now, private credit is backstopped, as we've talked about, in large part by some of these banks and the lines that they have with them. So any expectation that somehow this cycle, the credit performance is just going to be better because the bank's balance sheets look better, the risk is still there. It's just changed where it's hanging out, and it's maybe changed the form of what it looks like, but it's there. And so I think people will keep their heads in the sand as long as they're allowed to, especially when you see bank earnings as strong as we just saw. I mean, look, as Diamond said, this is about as good as it gets. They're not going to mention the fact that, oh, by the way, there's this kind of opaque component of our market and book that we don't really know exactly what the value is. That'll play itself out if and when it plays itself out, and people will deal with it kind of ad hoc when that happens. I think, and I don't blame them. Look, I think that's my kind of joking question earlier, is if this is sustainable. I mean, you look at these numbers, there's no way this is sustainable for any period of time backed by actual fundamentals in my mind. I mean, it feels like this is kind of a convergence of everything that's positive. And like you said, all boats rise. But at some point, the air is going to come out of here at some level. Equities are going to pull back. You're going to see some of these things start to struggle on the CRE side that we haven't seen. And the private credit play is still unproven at this point over a period of time. I mean, it's been great through the first couple of years post-COVID. We'll see if it continues that trajectory. This will be the story of this cycle, is if private credit holds firm, and the collateral performs and the credit holds, this will be the greatest thing that's happened to CRE probably in the last, multiple decades. If this crumbles, even if it's a 30% pullback or 40% pullback or whatever, the people that have been, pontificating about this, GFC 2.0 will feel certainly vindicated, because we basically just shifted the risk, prolonged the pain, and the stress is still there and needs to be worked through. I don't know which one will play itself out, but I think those are the two options that we have on the table now.
So I'm glad you mentioned some of the balance sheet and lending stuff here for CRE, Lonnie, because for today's episode, we do have a 101 on back leverage. So in other words, we'll be walking through some of the shifts that we've seen since the 2008 crisis on what banks are doing differently in today's environment than what they used to do. In other words, it's not a CRE loan held on their balance sheet. Instead, it's the bank making a loan to a firm that's holding the loan, and they're doing so because the capital treatment is much, much, much more favorable. So we'll get into that later in the episode. For now, the really interesting twist to the earnings story is IBM's preliminary results that were announced this week. Revenue increased only 1% to $17.2 billion, below Wall Street expectations, while adjusted earnings of $2.93 per share also missed estimates. Software revenue rose 5%, consulting was flat, and infrastructure declined 7%. Now, here's the really important element of this IBM announcement. IBM said customers shifted late quarter capital spending towards servers, storage, and memory to secure supply before expected price increases, while a number of large software deals failed to close on schedule. The stock fell roughly 25%, and the weakness spread across other software names. So this is important because AI spending is not necessarily lifting every technology company equally. As you mentioned, Lonnie, with the Matter comment, it's reallocating corporate budgets towards chips, servers, data centers, power, and cybersecurity. At the same time, the infrastructure required to support that investment is encountering growing political resistance. New York became the first state to impose a one-year pause on new data centers of at least 50 megawatts following local moratoriums in place, including Charlotte, Seattle, Oklahoma City, and Holly Springs. The concerns range from utility costs and grid capacity to water usage, noise, land use, and whether local communities receive enough economic benefit. So the AI debate is widening. One group worries that slowing development will leave the United States behind in the global technology race. Another is asking who ultimately pays for the power plants, transmission lines, and other infrastructure. And workers are increasingly asking what automation means for their jobs and the employment prospects of the next generation. That does not mean AI is about to trigger a recession or eliminate broad swaths of employment overnight, but this week's news shows that the story is moving beyond how much money companies are investing. The bigger questions are becoming where that investment goes, who benefits from it, and who bears the costs. So inflation cooled and banks remain strong, but the AI build-out is creating a new set of economic winners, bottlenecks, and risks. So this is where I have to put a quick plug for an upcoming report that we have in the pipeline. We had 3 large SASB data center deals get issued in June and July. I should say they got priced in June and July. And there was some interesting tension that came out of that pricing. So what we're doing in this upcoming Trepp research report is we're basically doing a post-mortem and decomposing the risks, the pros, the cons, the pricing, and getting really deep into the weeds of deal structure and risks. So I'm excited to talk about that one, but it's not for this week's episode. That's for a future episode. This week, we have something that's kind of following up from some previous research that Lonnie published on the Midwest multifamily. So we'll continue digging into some of the multifamily trends that we're seeing across the United States and some really interesting findings and takeaways. And one important thing that I'll mention now, and we'll get deeper into later, is some of the inflation tea leaves that I read as I was going through the granular detail and servicer comments. So there's some really fun findings that came out of this digging through the data deep dive.
So let's pivot here. Whether we're talking about data centers or multifamily, there's a theme that keeps coming up this week, and that's the difference between strong headline demand and the underlying fundamentals. So that's what we're seeing in Austin. In our Digging Through the Data segment this week, we wanted to look at the Austin multifamily market and specifically talk about rent concessions and watchlist rates. So walk us through what we're seeing here.
Yes, we've heard Austin come up a lot in various settings between headline news, folks on LinkedIn or X, and honestly in our own data, as you'll see in a moment. So a recent Trepp Siri Direct piece from our friend Carly Pendergrass put a spotlight on just how aggressive rent concessions have become in Austin. Roughly 36% of stabilized apartment units are offering concessions, more than double the national average, with a typical discount equal to about 15.5% of annualized rent. That follows a major supply imbalance. Get this, Lonnie, more than 75,000 units were delivered from 2022 through 2025, compared with roughly 52,000 units absorbed, and another 16,000 plus units were still under construction at the end of the first quarter. I mean, every time I keep hearing these multifamily supply numbers, it's wild to me because this is just a decades-long record-setting supply wave that we've seen.
It's still not enough. I mean, that's the reality. If you look nationally, I mean, that's the really weird dynamic here is that this is such a different geographic representation of like where you've had highly concentrated, significant, as you mentioned in Austin, new construction wave, but you have other cities that are, desperately needing new units that whether it be regulatory, higher, barriers to entry, cost of land, et cetera, that just haven't gotten the supply. So it's not something where we can say universally this supply has, alleviated the drought for affordable housing and available units. It's oversaturated the markets that maybe didn't need them. But that does have some upside if you're a renter. Look, if you're getting 15% reduction in your effective rent as a tenant, no one's complaining about that part of it. It's actually viewed very positively and lines up really great with kind of the resurgence of the Austin tech scene, where you're seeing some of these tech firms bring people in for AI, and the cost of living in Austin is considerably less today than it was, a few years ago.
Yeah, it's just wild when you have underbuilt for a decade coming out of the '08 crisis, and then you try and play catch up in a very short order. There's going to be a large disruption. And it's playing out, as is very clear in the data. The concessions have helped landlords preserve occupancy in many cases, but they have not necessarily preserved cash flow, quite obviously. So Carly has identified 30 Austin properties backing nearly $1 billion in securitized debt that were more than 90% occupied, but still had debt service coverage ratios below 1.0. So that raised a broader question. How much pressure is building across Austin's securitized multifamily market before loans actually become delinquent? As of mid-July, Austin's overall securitized loan delinquency rate was still relatively modest at 1.46%. So to be perfectly clear here, the universe of loans we're looking at includes private label CMBS like conduit, large loan, and SASB deals, but it also includes agency. It also includes CRE CLO loans. So at 1.46% delinquency, that's fairly modest in the overall scheme of things. But 15.76% of the MSA securitized multifamily balance was on the watch list. That's the highest rate among the 50 largest MSAs. Of the top 25 largest MSAs, just to put the delinquency number in context here, the top 25 largest MSAs, Austin ranks 7th. Across the 50 largest, they rank 12th. So of the 50 largest, for them to rank first on watch list is really saying something. Austin has roughly $3.43 billion of multifamily debt on the watch list. So what we did in a separate Trepp research piece is we look at that watch list universe of Austin MSA multifamily loans and break it down by securitization year and look at basically what vintages are contributing the most to that headline watch list rate and what some of the performance look like. How has debt service coverage or occupancy migrated since underwriting? The vintage breakdown shows that the pressure is concentrated in newer loans. The 2023 and 2024 vintages account for nearly half of watch listed loans, while those securitized from 2022 to 2025 account for 72%. That increases to 81% if we go from 2021 to 2025. So it's all of the new, this is probably no surprise to any of our listeners, it's really the newer vintages that are contributing. Across the full watchlist population, the weighted average occupancy has fallen from 93.4% at securitization to 85.1%, according to the most recent occupancy reading. DSCR declined from 1.35 times to 0.90 times coverage. The 2024 vintage alone has nearly $950 million on watch list, with DSCR falling from 1.33 times coverage to 0.85 times coverage on a net cash flow basis. 2023 vintage slipped from 1.29 times coverage to 0.80 times coverage. And 2022 cohort has seen occupancy fall by more than 10 percentage points. And I should mention, if I didn't already, all of these metrics are on a weighted average basis. So weighted by current loan balance. Servicer comments reinforce that this is primarily a market-wide operating story. I did a fuzzy text analysis on these watch-listed loans. So I went through all of these loans. I looked for 11 key phrases that said basically that either there were concessions or that effective rents declined. You can imagine the kind of phrases I was looking for. And then, in addition to that, I went manually through the remaining watch-listed loans just to confirm whether the servicer comments were unambiguously stating that market conditions had caused occupancy and or rent to decline. And so what I found out was about 65% of Austin's watch-listed balance was explicitly linked to weaker revenue and or occupancy caused by market conditions. Pushing 80% if you take a little bit more liberal stance and say that, well, if the borrower had not stated explicitly what was driving that decline in occupancy or revenue, we can pretty much guess that it was market related. I just want to mention that keep in mind, it doesn't have to be market conditions that cause a decline in occupancy or revenue. You could have, say, like an insured hazard cause units to go vacant, right? So you had a fire in one of the units, it spread to 2 or 3 other units, and a couple other units had to be vacated because of smoke damage as well, right? That could drop your occupancy by 10% and cause a temporary decline in revenue until those hazard insurance proceeds come through. So for me, when I'm trying to categorize this stuff, I do tend to take a little bit more cautious stance on how I categorize the reason for watch list or the financial conditions for the property. So the takeaway is that Austin's stress has not yet become primarily a delinquency story. It is showing up one step earlier. Concessions may help fill apartments, but effective rents remain weak and operating costs have stayed elevated, and occupancy stabilization alone may not be enough to restore debt service coverage. Just one last thought for you, Lonnie, because this is something I picked up on when I was digging through, it's probably close to 100 comments I just skimmed through. There was a recurring theme throughout so many of these loans that the landlords, the owners, were facing really a difficult situation with property management and leasing agents. You were seeing repeatedly comments of high employee turnover and basically having to double down your efforts on hiring. So to me, I'm thinking there's got to be a lot of operating expense cost pressure that's getting embedded into the Austin market. So even while we might see rents and occupancy stabilize here over the coming, say, 9 to 12 months, I'm guessing that there's going to be continued operating expense pressure that becomes stickier and more embedded with the Austin market. Because let's just ask the general question, how many good quality leasing agents can you really source as an owner within that market?
The one thing that I learned very quickly in this business is if you're on the leasing side of the house, you're in a week-to-week job. Every week that economic vacancy remains elevated and those concessions are high and your occupancy doesn't materially improve, the ownership group or the asset manager, whomever is like you're reporting to your numbers to, they're on edge because they're getting insane pressure from either the lenders, the owners, et cetera. So it was not uncommon. We kind of had a joke in our little submarket that it was like you worked for property A for 6 months, and if you got fired from property A, it sucked for about 10 minutes until you walked across the street to property B because they just fired their leasing agent that morning too. And so you went to go work at property B because they weren't achieving their occupancy thresholds either. So I think you're seeing some of that play out here. And the reality is the software, the websites, all the stuff they do to advertise, like that only gets you so far. You still have to have competent professionals that can show the units and entice people to sign the documents. So, I think that's real. It's always a part of this phase of the cycle. Austin's not immune to that. I will say Austin has a pretty deep bench though, with all the universities, with all the young talent coming out of there. Like I would assume it's probably less of an issue in terms of like attracting talent than it is keeping talent. Let me take a little bit of a different position though, Stephen. The data is very insightful, and obviously as we do, we'll share this either in a report or we can share this if you request it, or we'll talk about it, in one of our other channels a little bit more explicitly with maybe some visuals. But when you look at the DSCR at securitization and most recent, a pretty strong indication that 21 through 24 vintages are where the distress is. But if that also coincides with all of the new inventory and supply that hit the market, right? So like if I'm taking the counter here, I would just say what we know is Austin absorbed the largest supply wave in its history, and on the whole is still standing. Watch list is not great. You don't want to be on the watch list, but watch list doesn't mean delinquency. Watch list doesn't mean REO. It doesn't mean foreclosure. It just means there's potential. There's some signs that things are not great. So like they've taken the punch. They're still standing. They're maybe a little woozy, but they haven't fallen over yet. If you look at the supply clock, it's already flipped. It's now you're running the opposite direction. The wave is over, and now it's kind of calmed seas where if you can just survive and get your units absorbed and get the occupancy to stabilized occupancy, it's not going to be great in the near term, but if you just survive, the pendulum's going to swing back in your favor. And so if you look at absorption numbers, it tells that they're already winning the race. I mean, absorption across the last 12 months has been pretty significant, even though it maybe hasn't translated directly to cash flow because of the concessions as we've talked about. And then, concessions broadly, this is looking at the securitized universe, but if you look at all concessions across the spectrum, it's not the same story across every submarket. You have some submarkets and some properties that are already, weaning themselves off of the concession train, and they're starting to see some rent stabilization and maybe even some rent growth in certain pockets. And so multifamily, maybe more so than some of the other property sectors, is very submarket specific. This is not something you can say Austin broadly. You have to look at the submarket. Is it CBD Austin? Is it North Austin in the Round Rock Cedar Park area? Is it South Austin? All of those markets are going to be, is it East Austin, where they've had a lot of new construction and kind of a transformation? They've had some transit-oriented development, et cetera. Like all of those submarkets are going to operate slightly differently. And then lastly, if you look at the demand drivers, Austin has about 2.6 million residents. It's been growing almost 2% per year for the last several years, which is incredibly strong. And they've added about 18,000 new jobs, or that's what's projected for 2026. So you combine the population growth, you combine the new job creation, and I think the medium to longer term looks very positive. And I took the position in the paper we put out a couple of weeks ago that I think Sunbelt investing is where the money should go. And I think you're already starting to see that happen. I mean, these distressed properties are bad for the current ownership group, but for people that can come in that are well capitalized, that can buy these at a decent basis trade, they're going to do okay on this, because for all the reasons with lack of supply, et cetera, into the next 3 to 5 years, I think this is a super positive story. Not great if you're an owner and you can't survive. Solid if you can survive the next 18 months. Great if you're a new buyer coming in at a crazy low price relative to the last transaction, and you have some of these headwinds or the tailwinds that I've just talked about. So I think it's a complex story. It's nuanced. It's market by market, property by property. I'm still pretty bullish on Austin, all things considered.
So we have a lot to cover this week, but something that we've been reflecting on over the past several weeks is the topic of back leverage. So we wanted to cover this theme, especially today, because we were just talking about the capital risk from banks not having these on their balance sheets. So let's dive into this. Back leverage, which is also often called loan-on-loan financing, has a pretty basic idea. A fund owns a portfolio of loans and then borrows against that loan portfolio to increase its purchasing power and potential equity returns. So walk us through the cleanest way to think about this and some important distinctions.
Absolutely. So, this begs the obvious question right off the bat. Why doesn't the commercial bank just provide the leverage on the properties themselves, right? Like, why is there this seeming intermediary or debt fund in between? And we'll get to that in just a little bit. So the cleanest way to think about this is a real estate owner might borrow against a property. A debt fund borrows against a pool of loans. Those loans are the collateral, and the fund's equity is the first loss cushion beneath the bank. One important distinction here is that back leverage is not the same thing as warehouse lending. A warehouse line is usually temporary. It helps a fund or a CRE CLO issuer aggregate loans before a securitization takes them out. Back leverage, by contrast, is typically a credit facility against loans the fund already owns. It can remain in place while the fund holds those assets subject to the facility's term, covenants, and collateral performance. So why would a fund use back leverage? Well, it's quite simple. It increases their buying power, helps them turn a modest loan portfolio yield into a higher return on equity, and to capture the spread between what the fund's assets earn and what the bank charges on the back leverage line. So let's look at a numerical example. A debt fund owns $100 of transitional bridge loans yielding 8%. That means the loan pool generates $8 of annual interest income. A bank provides back leverage equal to 60% of the collateral value, so the bank lends $60. The bank charges 6% on that $60 line, and so annual debt service is $3.60. Contributes the remaining $40. The cash flow waterfall looks like this. You get gross income of $8, bank debt service of $3.60, residual to fund equity is $4.40. The fund's equity invested is $40 and it receives $4.40, which equals an 11% return on equity. Without back leverage, that same $40 of equity could only buy $40 of loans at an 8%. And so that $3.20 or an 8% return is definitely beaten by that 11% levered return on equity. So with back leverage, the fund earns the normal 8% return on its $40, plus it captures that spread on the borrowed $60. Asset yield is 8%. Bank financing is 6%. Spread is 200 basis points. And so the spread on that $60 of borrowed capital is $1.20. So $3.20 of yield plus that extra $1.20 in arbitrage equals $4.40 yield. Now, that's the upside case. The trade-off is that back leverage cuts both ways. Right? We always have to preach this in our real estate fundamentals 101 and real estate financing classes. Leverage is an axe that cuts both ways. Anytime you hear somebody say, well, leverage always increases your return. Whoa, whoa, whoa. That's obviously somebody who hasn't seen a full cycle, right? Leverage magnifies returns. Magnify can be positive or negative. So in the stress example, the portfolio's income falls by 25%. The $8 of income drops to $6. The bank still gets paid their $3.60, and that leaves $2.40 for the fund's equity. So $2.40 on that $40 of equity is a 6% return, right? That's less than the 8%. So you have that wide spread. You have 11% in the base case, 6% return in the stress case. And so that's the axe cutting both ways. That's a 45.5% drop in the equity return. It's wild, but that's what leverage does. There's also a collateral value risk perspective. If the value of the loan pool falls, the bank may not have to wait until there's an actual loss. If the client breaches a covenant, the bank may be able to ask for a pay down, additional collateral, or reprice the line. So using that same example, the bank initially lends $60 against $100 in collateral or a 60% advance rate. If the collateral value falls 15%, the pool is now worth $85. That 60% loan is now about 70% of collateral value. If the facility requires the fund to stay at 60% advance rate, the borrowing base would fall to 51, meaning the fund may need to pay down about $9 or post additional collateral. That is the key risk for the fund. The collateral value can arrive exactly when the asset values are falling, liquidity is thin, and selling collateral is least attractive. From the bank's perspective, this can be an appealing product because the bank is senior in the structure. It gets paid before the fund's equity and may have the ability to resize or reprice the facility before taking a principal loss. From the fund's perspective, back leverage is a way to convert a loan portfolio yield into a higher equity return. The fund is also taking a first loss position, and the return profile can deteriorate quickly if income falls or collateral values decline. So in summary, back leverage is not inherently good or bad. It's a return amplifier. In the base case, we had an 8% yield that turned into an 11% equity return. In the stress case, it was a manageable decline in collateral performance, but could have ended up requiring the fund to pay down the line or post additional collateral. So I should mention, this is based on a 101 piece that we put out. So if you want to receive a written copy of this 101 blog, please feel free to reach out to us at podcast@trepp.com, and we'll be more than happy to send that along.
I like the leverage analogy, Stephen, that people use about the fire, the campfire. You know, leverage can keep you warm on a cold winter's night, but it can also burn your house down. And, you know, I think your explanation of magnification is very well put. And, you know, I kind of chuckled as you were kind of going through that, because up until 2022, there was a whole generation of CRE professionals that had never seen a down cycle. They had only seen leverage work in the positive form as cap rates and interest rates compressed and values just continue to go to the moon. It wasn't until we saw an interest rate reset where people actually realized there's two sides to this coin. Now, obviously, for the folks that have been in the business and seen the GFC and others, they understand that very well. But there was definitely an 8 or 10 year period where values really did only go up and leverage really did just work to increase profit.
All right, so before we close today, we do have some deals and data to talk about in our property type news segment. I wanted to start here with a trading alert that we sent out to our clients this week that we'll give as an exclusive to our listeners here. We saw a large Chicago office property value slashed even further below its loan balance with our July remittance data. So walk us through what's happening with the Aon Center.
Yes, the Aon Center was recently reappraised at a 41% reduction, and the collateral value now sits further below the outstanding loan balance. Now, I'm just going to mention this one. Some folks may know this building by its original name, the Standard Oil Building. Now, we'll get to that more in just a little bit because there's some fun history to this asset. The property was appraised at $824 million at securitization in 2018. Its value was first reduced below the outstanding loan balance in May of 2023 when it appraised at $414 million, and again in September of 25 at $330.5 million. Its most recent appraisal issued in May 2026, but reported this most recent remittance cycle valued the property at $195 million. Now, we mentioned this loan in our July 26 CMBS upcoming hard maturities report, which reported that the borrower indicated it would be unable to repay the debt at its July 2026 maturity and formally requested a multi-year extension. Servicer commentary reports that servicing changed hands in April of 26 following the loan's default. The special servicer is negotiating a shorter-term forbearance of up to 2 years, potentially including a future discounted payoff option and enhanced lender protections to accelerate remedies and maximize recoveries if business plans fail to materialize. So this one has me really, really curious to get more details on. So I want to know exactly what enhanced lender protections will be. It's good to hear them say that, but what exactly will those be? So the loan collateral is a 2.8 million square foot urban office property in downtown Chicago. The property was built in 1972, renovated in 2018. Top tenants include Aon. Obviously, it's the Aon building. Well, the title tenant is not always in the building, but in this case, Aon is there, as well as KPMG, JLL, and Kraft Foods, who occupy 10, 8, 7, and 6% respectively on their leases that run through year-end 2030, August of 29, May of 2032, and July of 2033 respectively. For the full year 2025, the loan posted a DSCR based on net cash flow of 1.11 times coverage with occupancy of 66%. I mentioned some interesting history on this building earlier. So for our interested listeners out there, this building was originally called the Standard Oil Building when it was completed and was nicknamed Big Stan, serving as the headquarters for Standard Oil. Now, at the time of its completion, the building was the fourth tallest in the world. And currently it's the fourth tallest building in Chicago at 83 floors, surpassed by Willis Tower, Trump International Hotel and Tower, and St. Regis Chicago. Now, its title of tallest building in the world was short-lived. Here's some funny facts here. The Sears Tower, which is now called Willis Tower, was delivered a year later, and Big Stan was technically eclipsed by the Sears Tower when Big Stan was delivered, as the Sears Tower had already been topped out before Big Stan was delivered. So you got to love those technicalities. It was the largest completed building in the world, right? It wasn't technically the largest building, but the largest completed building. So when Big Stan was delivered, get this, Lonnie, it was only exceeded by the original World Trade Center and the Empire State Building. I mean, I love kind of the sequence of major properties and when they're built, because it gives you a sense of the sentimental value that as a business individual, you obviously don't attribute any value to sentiment, but maybe it does play some games in the margins. I don't know.
Whether it's sentiment or it's pride or it's, there definitely is. I mean, that's why you see this impetus for people to have the tallest building west of the Mississippi or in the, North America or whatever the case may be. Like there's definitely some pride of ownership of some of these things, even if, as you astutely pointed out, it was the tallest completed building. That's something they're definitely hanging their hat on. And for our listeners out there, that's just a glimpse inside the mind of Steven, when we call the mad scientist. Like those are the quirky data things that get him really fired up. So I'm glad that you got to talk about that on the show today, because I know as you read through that, when you found it, you were like, this is awesome.
But that's not all, though, right? The mad scientist had to go further. There's one last piece, and this one I think is really, really cool. So for Big Stan, the tubular steel frame structural system with V-shaped perimeter columns is the same construction method that was used on the original World Trade Center Twin Towers. So that makes this granite-clad building a very sentimental tribute to the Twin Towers we lost in 9/11. I feel like that's a really cool engineering piece, just worth noting. Now, one final interesting side note, and I think you'll like this one, Lonnie. The building cladding was originally 43,000 slabs of Italian Carrara marble, but that ultimately proved to be a structural mistake. A 350-pound marble slab detached from the facade in 1973 and penetrated the roof of the nearby Prudential Center. I mean, basically, right when this thing was delivered, it was already having issues with the cladding. So ultimately, those original 43,000 marble slabs were replaced with Mount Airy white granite from 1990 to 1992 at an estimated cost of over $80 million, which was over half the price of the building, the original price of the building, without accounting for inflation. I mean, that's absolutely nuts how much you had to spend to reclad this building. Now, I mean, every week we could say this. There's so much more news that we don't have the time to get through, but I just want to throw out a couple headlines that I feel like were noteworthy over the last week or two. Airbnb made a surprising move in New York City, buying 281 Park Avenue South for $82 million. This is a 42,500 square foot building. So this 281 Park Avenue South purchase by Airbnb is really interesting. It pencils out to an eye-watering price per square foot of just under $2,000 per square foot. It was originally listed in 22 for $3,176 per square foot. So there's a lot more behind this, but it's an interesting move for Airbnb to use this as office space, given that Airbnb is still continuing to lobby New York City to loosen restrictions on short-term rentals imposed under local law 18. Now, another headline moving to multifamily is that Chicago's older apartments are running out of room to raise rents. This one was from BizNow. Chicago's older Class C apartment stock is facing a margin squeeze despite strong occupancy and limited new supply. The long and short of it is renters are already pressed on a rent to income basis. And so while expenses have increased and to maintain margins, you want to push rents, there's probably not a whole lot of room left in that Class C stock. So this is a really interesting article. We don't have time to get through it on the pod, but I would encourage you, if you're interested, to check it out. This also relates to Lonnie's Midwest multifamily piece that we talked about on the pod recently. So anyway, just wanted to throw that one out there because it is in line with some of our other content. And then finally, one other piece in the multifamily space, Marriott is opening its first branded apartment property in Cleveland.
I'm still a little bit surprised that Cleveland is where they chose to kind of launch this venture. They must know something I don't know. But yeah, this is inevitable, I think, at some level.
So this project will combine roughly 200 hotel rooms with 227 apartments and is scheduled to open in 2027. It's a $218 million project that's basically branching out from the W branded residences. So this will be an interesting project to watch. And then finally, just the last property segment I wanted to hit, industrial, and specifically data centers. We mentioned earlier in the pod that the New York governor signed the first statewide data center moratorium, halting $10 billion of development. I mean, this is a major one. Granted, it's only for 1 year, and it's for projects of at least 50 megawatts, but this is delaying a pipeline estimated at roughly $10 billion. And this is not the first, right? We've been talking about this for weeks, about moratoriums at the city, county, and murmurings at the state level. Well, here you go. But that's not the only state in news this past week or so. North Carolina is also coming up. $20 billion of North Carolina data center construction has been canceled amid a moratorium debate. So the long and short of this is projects are now really kind of hitting en masse. That pipeline is getting truncated hardly. And Lonnie, you talked about this. At some point, does this come up to the executive branch? Because I think the moratoriums are reaching that critical mass level of we are severely impairing the delivery of data center stock. Will that put us behind in the AI race?
Listen, it's already put us behind. The fact that we're even talking about this has put us behind. And the reality is this is just more regulatory bureaucracy nonsense that's supposed to stay out of the marketplace from a CRE perspective. Like, listen, local municipalities, state agencies, they can decide what they do and don't want to issue building permits for, et cetera, et cetera. But I think these moratoriums or these kind of like legislative, administrative actions that they've done or statutory prohibitions is just too far. I mean, you should look at these based on the merits of the individual data center that's being applied for, the permitting, et cetera, make determinations. This wholesale approach, to your point, to my point earlier, is just, this is going to lead to some sort of federal intervention that I think says, as a country, we're not going to allow these states to prevent us from being the best in the world from an AI perspective. So we'll see if that gets accelerated. And listen, at some level, the cynic in me says that that's kind of needed for us to get the type of backing, support, innovation, et cetera, that we need to solve some of these power and water issues that these local governments probably don't have the capacity to solve for themselves.
Now, right on the heels of those announcements, or I should say alongside those announcements, there was one other headline that I wanted to bring in here. The data center firms DataBank and EdgeCore are reportedly courting buyers. So as the pipeline is getting truncated and it's creating supply pressures, there's no shortage of demand. So what happens when you have, well, short supply, but more demand? Price gets pushed up. And so they're going to the market, reportedly exploring stake sales as record demand pushes platform valuations higher. a potential data bank transaction could value the company at nearly $25 billion, with its owners reportedly considering the sale of a majority stake. DataBank is backed by Digital Bridge and other investors and operates co-location and single-tenant facilities across 27 states, 27 US and UK markets. EdgeCore is also soliciting offers for an ownership stake. The Partners Group-backed company develops large single-tenant facilities for hyperscale customers and operates or is developing campuses in Virginia, Phoenix, Silicon Valley, and Reno. So this is really interesting. You've had some major deals like Blackstone's acquisition of a 49% stake in Rowan Digital Infrastructure and the nearly $40 billion purchase of Aligned Digital Centers by Global Infrastructure Partners and MGX. So this seems like some very well-timed plays on the data center side. So there's a lot more TreppWire credit stories that we didn't get to cover in this week's episode. So just to break those down and tell you roughly what we were talking about this week in TreppWire, we had a number of different stories. The two major themes were special servicing transfers and appraisal reductions. We had 8 loans totaling $338 million on special servicing transfers. Those covered 3 office, 3 retail, 1 hotel, and 1 multifamily. The primary drivers were imminent maturity default and not cash flow collapse. And this is a widespread geographical dispersion, no single regional cluster. For appraisal reductions, we had 7 loans totaling $872 million. This was office heavy. 5 of the 7 appraisal reductions were office loans. And the magnitude was commonly 40 to 75% cumulative declines. And the status put most of them at below loan balance, often after multiple prior write-downs. In other words, this isn't like the first appraisal reduction event. This is the cumulative effect of multiple appraisal reductions. So if you want to get any of those stories that we talked about, if you're interested, one of our podcast listeners who doesn't get the TreppWire credit stories, reach out to us at podcast@trepp.com, and we can give you some additional info if you're interested.
So we had a lot to cover today. And actually, Lonnie, I think you were joking right before this show that maybe one day we should do a special episode where we just have you guys riff for as long as you can go. And I think it might be like 5 or 6 hours where you guys could just talk about so many stories because there are so many headlines that we miss and we can't cover. So if you would like to hear that, reach out to us at podcast@trepp.com and we'll let you know if that's something we'll do. But I do have a lot of programming notes here today, so I'll run through those very quickly. We have some upcoming and exciting webinars for our clients and anyone in the industry. So on Tuesday, July 28th at 2 p.m. Eastern, we'll have our next client-only webinar for our Trepp CRE clients. These are always really well attended. We have everyone from new users to longtime users who are interested in seeing our new developments and what our team is releasing every week and every month. This month, we will be sharing our expanded alerts functionality. So in our platform, you can create and manage alerts for properties, loans, markets, anything that you're interested in tracking. And you can basically wake up every morning and get an alert to see which loan, which property now meets the criteria based on performance rates or anything that you're interested in tracking. So this session will help you learn how to create those alerts, configure notifications based on the latest Trepp data that we have, and really take advantage of all the new capabilities that we design every day to help you stay informed on the properties that matter most to your business. So if you're a client, you want access to that training, reach out to us at podcast@trepp.com. And if you're not a client and you'd love to see how this alerts tool works or what data we have, reach out to us and we'd be happy to set you up on a call. That same week, on Thursday, July 30th at 2 p.m. Eastern, we will be hosting our 44th, is it, Lonnie and Steven? Market Pulse webinar, 44th consecutive, which is amazing. So in this session, we have a pretty cool theme that we've put together here. We'll be following the CMBS loan life cycle from origination and underwriting through operating performance and today's refinancing environment. So in this session, we'll talk through a peak cycle vintage check, where we'll dive into how 2021 and 2022 CMBS vintages have performed since origination and what distinguishes these loans from prior lending cycles. We'll talk about from underwriting to reality, where occupancy, DSCR, NOI, and other fundamentals have diverged from the original expectations, and we'll look at that across property types and markets. And then we'll do a 2026 refinance test, looking at which upcoming maturities appear positioned to refinance successfully and where there may be funding gaps and risk. So if you're interested in this webinar, reach out to us at podcast@trepp.com and we will get you access. We've also been very busy on this podcast hosting a lot of guests. So this week we released a special episode with Justin Stein, the Chief Revenue Officer at Tanger. This was a really interesting episode. He discussed all about Tanger's evolution from an outlet retail leader to an operator of true open-air lifestyle destinations. He was very transparent and he talked us through their strategy and where they see the future of retail. So if you play in that space or you'd like to hear how the retail market is doing, definitely check out that podcast episode. And coming next week, we'll also release our special episode with Marty Allen, the head of capital markets at Grand Bridge Real Estate. And we got to talk to Marty all about their newly launched master and special servicing platform and why his firm saw market conditions as ripe for a new entrant. And he'll also walk us through what he's seeing from a servicer's perspective. So that is a really interesting one, and we're excited to share that with our listeners. We gave this a shout out last week, but I wanted to remind everyone that we partnered up with Eisner Amper to develop a real estate market update. We analyzed property level operating trends, capital market data, and regional performance across 8 major U.S. markets. So if you're interested in getting a copy of this report, please reach out to us at podcast@trepp.com. And if you feel like at your firm you're missing the data, you have a thesis, you have a story you want to tell, or you really want to just get some of our expertise, reach out to us. We'd love to partner with you on joint research papers, joint webinars, or any way that we can help bolster your thought leadership and really get your message out there. Turning to shout outs, Owen N. reached out to us and said he's a rising senior at Northwestern University and is currently interning for a commercial real estate credit analysis team in Chicago. His mentor recommended the podcast and he wanted to share a lot of takeaways and some questions with us. So we really appreciated your thoughtful email, Owen. He said he's early in his career and really interested in breaking into the commercial real estate capital markets world. And he plans on listening closely and thanks us for our time and putting out this content. So, Owen, we so appreciate you reaching out, and you're doing exactly the right thing, listening to this podcast, educating yourself, and asking really great questions. Jessica C. reached out to you, Lonnie, and said she loves the podcast and shared some feedback and thoughts on the Midwest multifamily piece. Brandon D. emailed and said he's a longtime fan of Trepp and appreciates all the hard work to create the best podcast in the industry. He was interested in the Eisner Amper market outlook piece that we talked about last week. George J. loves the show and makes his whole family listen in car rides. Bobby T. thanked us for working on this podcast every week. Miriam L. enjoys tuning in every week and wants access to our Market Pulse webinar. And Greg W. would like to learn more about our CMBS data and our AI capabilities. I think we have a lot more shout outs this week. Lonnie, you've been fielding emails left and right from your recent reports that we've put out. And we've seen a lot of great engagement on LinkedIn, so we'll round some more of those up for next week's show. And if you haven't reached out yet and you've been a loyal listener or you're a new listener, send us an email or connect with us on LinkedIn. We'd love to chat and hear what you're working on, what you're seeing in the market, or any thoughts or feedback you have for our team.
So I have one quick shout out this week to Trepp's own Tom K. He turned me on to a fun term to describe some of the pushback you've seen in the AI space, in the build-out space, called a Luddite. And this was some history I had forgotten. So in this upcoming data center piece that I put together, I'm terming this the AI Luddite Premium. So for context here, a Luddite is a historical reference to a 19th century English textile worker who destroyed automated machinery to protest poor working conditions and job losses. So what I'm going to coin, the term AI Luddite, is simply a tongue-in-cheek reference to describe the general opposition to the build-out of AI infrastructure, not intending to be anything derogatory, inflammatory, but simply a nice nod to some English history here. And, well, history often rhymes. It may not repeat itself, but it does rhyme. And so the pushback you're seeing in the AI space, to me, this feels a little bit similar. So that's what I'm using in this upcoming research piece to describe some of the premium that's baked into some of these recent SASB data center deals.
And with that, we'll close. Thanks to our producer, Carly Cento. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or just a comment, send an email to podcast@trepp.com and subscribe to the TreppWire Podcast with your favorite provider. Thank you for listening and stay well.
All right.